All right, today we are doing a deep dive into a single, really powerful case study. We're going to look at a bearish setup in the NASDAQ futures. And I mean, we're going to deconstruct the entire trade from the big picture framework right down to the nitty-gritty entry. The goal here is so you can see how these concepts work in the real world. Let's jump right in. So here's the game plan. First, we'll set the stage with the high-level bearish framework on the daily chart. Then we're going to zoom all the way into the 1-minute chart to see the specific signals that told us it was time to act. After that, we'll watch how the trade actually played out, and maybe most importantly, we'll pull out the key lessons and some advice you can actually use in this volatile market we're in right now.
Okay, so let's start with the foundation. Every single high-probability trade you'll ever take starts with a clear thesis on a higher time frame. It just has to. Without it, let's be honest, you're just gambling. For this specific trade, our entire bearish idea was anchored to one specific level on the daily chart.
And the whole trade really hinges on this one concept, the daily suspension block. Just think of it as a well-defined zone where we're expecting some major selling pressure to show up. But the real magic, the secret sauce, is right at its midpoint, what we call the consequent encroachment. This single price level was our line in the sand. Honestly, it was the only resistance level that even mattered.
And this, right here, was the #1 rule for the trade. The thesis was incredibly simple. As long as the price stayed below this midpoint, the path of least resistance was down. Look, this isn't about having a crystal ball. It's about having a clear, predefined level and simply reacting when price gets there.
So now that we have our daily bias, let's drop down to the 1-minute chart. A daily level gives us our direction, right? But we need the intraday price action to confirm that bias. This is where we look for real-time proof that sellers are actually showing up and defending our level. We were watching for a very specific 3-step confirmation. First, we just needed price to rally up into our resistance zone. Check. Second, we needed to see rejection. You see those long wicks on the candles? That's a classic sign that sellers are just smacking down any attempts by buyers to push higher. And the final piece of the puzzle was an SMT divergence against the S&P 500 futures, which basically confirmed broad market weakness.
And this is where you see that final piece click into place perfectly. So on the left, you've got NASDAQ futures just barely poking to a new high. But look over at the S&P 500 futures on the right, they couldn't do it. They actually made a lower high. This is a classic SMT divergence, and it's a huge tell that the rally is getting exhausted and doesn't have the support of the broader market. That was the final green light for the trade. So the framework is set, the entry signals are all there. Now let's see exactly how the market responded. This is where the theory meets reality, where the rubber meets the road. And to absolutely nobody's surprise, the first thing that happened was a hard rejection right at our daily midpoint. Price came up, tested it, failed, and sellers immediately took control. You remember those rejection wicks we were looking for? Well, that was the market showing its hand right there.
Now, once price was rejected, it had a very clear destination. The first logical target was the new week opening gap sitting just below. Gaps like this, they often act like magnets for price, and filling them becomes the market's first order of business.
But after filling that gap, the selling was not done, not even close. The next major target was those pools of sell-side liquidity, which is really just a fancy way of saying all of the stop-loss orders sitting below recent lows. Price just cascaded downward, hunting for those stops, which of course just added more fuel to the fire. Okay, so the trade has played out. Now for the most important part, really. Let's distill the key lessons from this whole thing that we can actually apply to our own strategies going forward. So what's the core takeaway here? Well, it's really about the power of patience. Instead of chasing a breakdown, the high probability play was to just wait. Wait for price to rally into our predefined resistance zone, and then show us weakness. Selling into that strength gave us a super clean entry, a really well-defined risk, and it put the odds firmly in our favor.
It's also so important to understand the market we're in right now. I mean, this is a difficult, choppy, and extremely volatile environment. Clean setups like the one we just walked through are, frankly, a lot rarer, and failed moves are happening all the time. This makes careful analysis and disciplined risk management absolutely non-negotiable.
So, given this challenging environment, how do we adapt? How do we navigate these tricky conditions? Here's some practical advice. 4 things to really drill into your head. 1, reduce your size. Just do it. Protect your capital. 2, get rid of emotional decisions. No revenge trading. 3, if you're new to this, you have to know when to sit on the sidelines. Waiting for a clearer market isn't a weakness, it's a professional move. And 4, please remember that in this market, patience isn't just a virtue, it is your single greatest asset. So I'm going to leave you with this question to think about. In a market like this, we all get obsessed with finding the perfect strategy, right? The perfect setup. But what if the real key to survival and success isn't the setup itself, but your discipline to wait for it? Is it possible that right now, your patience is far more important than your strategy? Something to think about. Thanks for tuning in.